Today, folks, we're discussing everything deep discounted territory with stocks you recommended in that comment section. From my eyes through my mouth to your very judgmental ears here. If we're going to do a lightning round like a Jim Cramer style ski daddy, let's get at it. If that's a conversation you appreciate, hit that like button. We're talking tobacco. We're going to be talking banks, financial institutions, REITs, growth tech companies, and things that I just generally find entertaining. Now, this is not financial advice. These are just my opinions. Keep that in mind, but let's get right into this with first and foremost, MO Altria Group. My goodness, this thing is paying an 8.58% dividend yield. It is now trading down again on the year, 12.57%, still doing better than the S&P 500 this year. And a lot of you are kind of like, well, this should be a good buying opportunity because the government's kind of coming down on nicotine. They've never done a good job at this, but it's still hindering the stock, right? And over a 5-year return compared to the S&P 500 has been abysmal. I own this stock for quite some time. The management really sucked and turned me off. I sold out of it, and I've been a vengeance against this stock ever since, Batman style. But let's talk about it, because first and foremost, I was going to the free cash flow, which they've had troubles growing the free cash flow. But when we actually take a look at the quarter over quarter revenue, it has been dropping fairly consistently, but the EPS numbers have still been good and they've been beating analyst expectations. How have they been doing that? Well, I'm going to talk about why this is a problem, because when we go into the most recent presentation, they're like, responsibly led the transition of adult smokers to a smoke-free future. Responsibly, you're saying that Juul investment that you made in, that you got all these kids hooked onto it, that is now banned, that was responsible of you? I mean, that's only just the start, because then we look at the diluted EPS numbers and they're growing and it's great. It seems very valid, but I'm going to tell you why it's not when we actually look at the numbers in a second. And they're like, oh, continued on share growth. They're dominating the sector of the chewable and oral tobacco segment, but really, you know, they're actually losing buyers of these, and so is all the other competitors. So their market share grows. They manipulate the hell out of their presentation. I absolutely hate this company. But take a look at this, because when we take a look at the net revenue here, guys, you know, when we take a look at revenue net excess of tax, it's up 2.2%. So you might be thinking to yourself, hey, revenues are growing. They actually have room. They can afford the dividend. That's all great stuff, right? But the reality is cigarettes is the biggest part of their entire income segment. Now, don't get me wrong. I don't hate the whole tobacco sector. I just hate the U.S. tobacco sector, which is all MO is unfortunately stuck to, right? But when we take a look at their total cigarette sales in the billions, I mean, in the millions, but this is 22 billion sticks of tobacco sold, right? From 2021 to now, where it's 20.6 billion, which is a decrease of 6.3%. And considering like well over 50% of all their income is coming from these tobacco segments, with total smokable products down 6.4%, you know that they're just increasing I mean, everyone knows how expensive tobacco products are in stores. Basically, every time they keep losing out on people smoking, they just raise the price by how much they're losing in volume. So they'll probably raise the price by 6.4% to make those EPS numbers still look sustainable. But you guys know they failed at Juul. They tried to get involved with IQOS when it came to Philip Morris. They got barred from that. They tried to get into the MJ sector with Kronos Group, and everyone's like, oh, they're going to do so well in the MJ market when it's legal in the... No, they're not. No, they're not. They haven't proven any time in the past where they've had good management skills at pulling that off. So why do you think they're going to continue to do it well in the future? I do not trust anything this company does, and I would much rather stick to those larger globalized tobacco companies where they're still seeing growth segments in other countries. But putting MO aside and my hate for it, you can have your own opinion. That's up to you. But let's talk about Facebook real quick before we talk about REITs and financials and all that stuff, because Facebook right now is down 58.96%. I can't get over that their PE ratio is at 11 right now with a $400 billion market cap. And this gets crazy. Like insanely crazy to me, because when we go into their total assets, guys, they're sitting on about 47 billion in cash. When we look at the free cash flow, about 48 billion. But when we go into the free cash flow, guys, they're going to be making about $40 billion in free cash flow this year. You pop that on, you know, with the current cash position this year, they're expected to have $100 billion come into their laps. That is literally almost a quarter of their entire market cap value in a single year. That's obviously, you can't just count on that. I mean, that's not one way to value a stock, but you couldn't go back 2, 3, 4 years ago and see the same kind of metrics, which is just mind blowing, right? And I recently was listening to Jim Cramer, who talked actually with Mark Zuckerberg, and they were testing out the Oculus and the VR stuff. And I kind of segmented it and cut it down, because these guys are boomers. They're funny to listen to when it comes to this kind of tech. So take a listen, and I'll offer some anecdotes after.
Darn. Well, better be a big theme.
Oh, there it is. You do look like a strip club bouncer.
My actual avatar in the metaverse from Moran
is much better. Yeah.
All right. Well, let me just tell you that when you have a meeting in it, you can whisper to a person. You can't do that in Zoom. It's a kind of an anti-Zoom thing. In other words, the office is much better.
Listen, the enterprise
is much more
usage of this may
surprisingly
become
good.
very significant from
Yes,
afar.
but also
Now, I made
play.
the argument yesterday, you're still not going to walk halls and bump into people that you might otherwise not, and have
No, but
conversations
this
you
is
might
so much
otherwise
better
not.
than Zoom. You have very personal. I mean, at one point, I'm talking to Mark.
You know you look ridiculous.
In my outtakes, and
look-
he's talking about something, and I say, wait a second, do you really have green eyes? Yes, my eyes are green. And I said, I look really great in the metaverse. He said, well, you know, the suit is well-fitting. I said, no, I'm jacked in the metaverse. He goes, well, we decided to make you look strong in the metaverse.
We can all look.
And then,
But when they talk about it, the only thing they fixate on is like meetings and things that are more practical to their own personal lives. And I think it's kind of ignorant to the fact that the real value for Oculus is going to be in gaming. It's going to be in NFTs, the future of crypto, things that Mark Zuckerberg has touched many times on in the past. I still use this thing utterly religiously. I see the value in it. The problem, however, is TikTok is dominating their primary business right now. TikTok in this weird environment, this depressionary period, guys, they're seeing like a tripling in their revenues. Like, it's insane. Facebook is not going to get that because everyone's already signed up. Now, obviously, I think there's going to be some degrading of their primary platform kind of in the coming quarters, but they haven't fully monetized it when you're talking about WhatsApp, Facebook Marketplace. It's just, I think they have some real potential in the future, but it's not like it was a couple years ago when I owned Facebook, where they were getting this 18-20% growth rate. That's going to get diminished, and you're going to be more reliant on these future technologies to bring that extended growth rate, I think, into the future. But there's still a huge amount of opportunity here, and I still like Facebook a lot. So let's kind of continue to move forward here, and we'll talk about the king of kings when it comes to value investing, and that is Berkshire Hathaway here. We're currently worth $585 billion. Year to date, outperforming the S&P 500, but we always want to look at least a 5-year basis, up 58% against the VOO index, the S&P 500 index from Vanguard, which year to date is underperforming Berkshire, but on a 5-year basis still outperforming, because unlike Berkshire, you get a dividend from the S&P 500, which if you reinvested the dividend, you know, you get about 1.5 to 2%. You're going to be actually beating the capital return of Berkshire. Now, Berkshire scares me a little bit because they're not nearly tech-focused, forward-thinking, and I don't really understand the decisions they're making right now in their investments, because obviously Apple sits at the top of their stock list because they have a lot of private equity as well that doesn't get iterated in their, you know, security holdings. However, when you got to understand about Berkshire here, guys, is they're going real heavy into Occidental Petroleum right now. They keep buying it, and I don't know why, you know, like in the March 2020 crash, why they're not more fixated on tech companies like Facebook, like Google, when we know that's where the real future value is going to come from. Because let's be real, oil, even though it's really cheap, it's pricing in the idea that 10, 20 years from now, we're going to lose the entire auto industry, petroleum. I mean, you're going to lose so much. Hemp is really taking over a lot of manufactured petroleum industries, and you just know in this kind of carbon emitted free future that governments are pressuring so hard toward, you get why oil trades at a cheaper discount, because 10, 20, 30, 50 years out from now, I just don't see why you want to just be endlessly throwing money at it. I get exposure to it. It's discounted, but from a long-term visionary standpoint, I don't really get it, so I've never been inclined to really buy Berkshire. I'd rather just buy the dividend ETFs that weight a lot of companies that Berkshire has when you're talking about telecom companies, oil companies, bank companies, which let's talk about some banks with JP Morgan. Jamie Dimon, in Jamie we trust, because JP Morgan right now is trading down pretty dramatically this year. I mean, it's down 34%. The dividend yield's at 3.58 and the PE is at 8.3. It's a double-edged sword in an interest-raising environment, because not only can they make more money, usually they get hit and impaired right at the beginning because people slow down on real estate deals, taking out mortgages until the market adjusts to the current market conditions. And Jamie's not sure how bad the hurricane's going to hit the market, but honestly, I really think the markets are going to find a bottom long before we see the end of inflation starting to cool off. And as soon as that data hits, that inflation is cooling off, we start seeing some better data come out in the next quarter or two, I think the markets will start rebounding a little bit more aggressively. And I think this is a huge buying opportunity. I mean, the banks, man, they're just crazy how much cash and management, you know, 3.7 trillion in assets against the liabilities, which banks always have a lot more liabilities. It's how they operate of 3.44 trillion. Just crazy stuff. So I love my financial institutions. They're one of the largest sectors of my portfolio, which we'll talk more about next week. From a REIT standpoint, however, things get confusing. REIT balance sheets are hard to understand because you really need to pay attention to when lease structures come back due, because as leases have to come up to their mortgage renewals, they're going to be coming in at higher rates. So the market's trying to price that in for things like MPW. STAG is a huge growth proponent to it, which logistics centers are starting to slow down. Amazon canceled 10 million square feet And Stag's largest tenant is Amazon. However, again, these things priced a lot of that in really, really aggressively. And whether you think interest is going to go dramatically higher or not dramatically higher will really dictate on where these stocks go, because they've currently priced in some pretty wicked increases on interest rates. So I think, I'm not sure, not financial advice, but I don't think you can do too wrong picking up some of these growth-based REITs like Canadian Apartment Properties REIT. I'm very fixated on them. I still hold my REITs like RioCan and Smart Centers, but again, that's kind of more personalized to what kind of REITs you personally enjoy if you're interested in that sector. Now, from the market standpoint today, it looks like we're still trying to find a bottom. Bitcoin's hovering around 20,000. We haven't seen any more severely aggressive drops, but like I said, it's hard to imagine we're not heading into a recession when you're watching $30-50 billion crypto projects going bust. That's what happens when you have unregulated loaning. And, when you're looking at stocks and oil and everything correcting right now, I think it's really giving a fixated idea that we're heading into some bad times. How bad, that's the problem. We don't know, and how much of that's priced into this current market. Nobody knows, but we don't play off political predictions and Federal Reserve, interest raising stuff. We just buy what we think are good assets at good prices and cost average into them for the rest of our life. And that's what we're going to see on this channel, right, as I continue to adjust my risk tolerance. But I want to pass the question off to you. What do you guys think about these undervalued dividend stocks, growth stocks? They're ones that you guys ask a lot about. Hopefully I gave some clarity here, but let me know what you think in the comment section below. Stay cool, stay awesome. And as always, I look forward to catching you in the next one.